Jacob Field here once again for episode 5 of the High Performance Property Investment Podcast. Today I am joined by a very special guest, someone who I have respected and worked with quite closely now for many years in the property investment industry. It's Richie Muir, the legal director of Lawlab, which is a nationwide conveyancing company. They are the best in the business, someone as borderless investors like ourselves we use extensively to be the legal team for each individual purchase, whether that's in Queensland, WA, or anywhere across the country. And I have brought Richie on today to talk about the new land tax policies and changes in the Queensland state. So thanks for joining us today, Richie.
Thanks very much, Jacob. Thanks for having me. I'm very excited to be here.
It's my pleasure. I've been looking forward to having the chat, and obviously you always have a way of spicing up the law and legal concepts. So let's see how we go. Just before we jump in, so this is a topic, obviously, in the last few weeks, the Queensland government almost out of the blue, I wasn't really aware of any commentary around this or even leanings towards this type of policy. They did release an amendment to their land tax system or proposed policy. It's not proposed, it's actually coming in, and I'll get you to expand on that in a moment. And it has caught investors in Australia by surprise. It really is unprecedented, the reach that they are actually proposing that they are going to be going to shortly. So I thought, none better than you to come on and talk about those changes. Do you think, Richie, you might be able to give a high-level helicopter view of what those proposed land tax changes are?
Yeah, no, you're right, Jacob. There was announcement late last year from the government that they intended to do something like this.
Yes.
And then it seemed to peter out, that there wasn't much media attention or other announcements about it until really the legislation was passed a few weeks ago. So you're right, it has caught a lot of people by surprise in that respect. So yeah, on a high level, what it does is it changes the way that the land tax is assessed in Queensland, and it is unique to Queensland, whereby before land tax is assessed essentially on land just in Queensland. What they're doing now is using the value of the land you would own in other states to work out the total land value of your holdings in Australia, and if that is over the tax-free threshold in Queensland, which is 600,000 for individuals, then obviously they would calculate land tax on all of your Australian holdings, and then actually assess the Queensland component of that. So it's a percentage of your overall holdings, but
yes,
what that means in practice is where you might not have had a land tax liability before, you are likely to have one now. So it is a big change, and it will impact a lot of investors in Australia.
Hey, just quickly, before we continue with the Queensland Land Tax live session with Richie Muir, I wanted to make sure you know about Ripehouse Academy's even playing field system. If this is the first you've heard of it, make sure to click on the link in the description so that you can get full access to how it can help you with property investing. Now let's get back to the live session. So let's unpack this. I'll just try and summarize things from my layman's perspective, if that's okay, Richie, and then you can say, no, that's not right, or yes, you're on the mark there, Jake. Sure. So previously in Queensland, and this is, it's not uncommon or it's not unusual for this to be the case in other states as well. I mean, land tax is a thing generally across Australia, but in Queensland, the current system is, if you own properties and it's the land value, it's not the building value, it is the assessed land value of that property. If you own one or more properties and the total assessed value of that land component is more than 600,000, then you pay land tax across all of them in those properties.
That's right. So the land value is based, or the taxable value, as it's technically called in Queensland, is based essentially on the unimproved value of the land. So just the land, no improvement on the land. Your principal place of residence is exempt from that.
Yes.
As is primary production land. So it essentially applies only to investment properties you own.
Yes.
And there's different tax-free thresholds depending on whether you own the land as an individual or you own own that investment property as a company or a trust. So for individuals, if the unapproved value of your investment land is over $600,000, then you'll have a land tax liability.
Understood. And we will be unpacking some, how these policies come into act and, how they are actually applied, and is there any rights of repeal, etc. And I will be talking in a moment as well about potential impacts for investors and how that might change the states or where we actually invest and what we do. But the new system, if I were able to summarize once again, the new system is if you own, say, one investment property, $500,000 assessed value in Queensland, that's great. You've got that property, good investment property, no problems. Well, you're not paying land tax on that property because the assessed value of it is under the threshold for an individual. Now, the case is you've got that Queensland property, and if you own another investment property in, say, New South Wales, you've got another investment property there that's got $1 million in assessed value. Now, Queensland is looking at your total portfolio across all Australian states and then adding the $500,000 to the million and then saying, well, now across your portfolio, you are over the $600,000 threshold in Queensland. You now need to pay land tax on that $500,000 asset. So you're not paying land tax across the whole 1.5 million. You're paying land tax now on the $500,000 properties when before you actually wouldn't have been. Is that correct?
That's exactly right. And it may be the easiest way to do it, using your example there to just run through. So in that $500,000 unapproved land value in Queensland, there would be no land tax liability, assuming you owned it in your own name.
Yes.
If you had the $1 million unapproved land value of a New South Wales property, that's as of when this system starts, they'll be added on. So your total unapproved land value of holdings in Australia would be 1.5 mil. That's obviously above the individual threshold of $600,000. So there will be a land tax liability based on that. And because 500,000, the Queensland proportion of that is obviously 1/3, so 500,000 of the 1.5. So they work out that total land tax amount on the 1.5, and then they would divide that by 1/3 to give your Queensland land tax liability.
Understood. So look, it is unprecedented. I mean, there is a potential scenario where you're double dipping as well. You might be paying land tax in one state and then also in Queensland as a second time. Is that the case? Am I reading that correctly?
Land tax is state-based tax. So in that example, if you own that $1 million unapproved land value in New South Wales as an individual, I believe the land tax threshold, tax-free threshold in New South Wales is $800,000 or so. So yes, you would have a New South Wales land tax liability, and you'd also have a Queensland land tax liability.
So just to clarify my thoughts a little bit, you wouldn't be essentially paying land tax twice on the same dwelling, but you would be paying land tax on the New South Wales dwelling separately, and then you'll be paying land tax now on the Queensland dwelling when you otherwise wouldn't have.
Correct. That's right. Yeah.
Yeah.
So they're charging land tax. A land tax new system charges land tax liability on the Queensland land, but as a proportion of your overall Australian land holding. So it's really a system where it's bumping people up over that tax-free threshold where they otherwise wouldn't be.
Yeah, it's almost to the case of there's no real threshold anymore if you own interstate properties, because you'd think with two properties you're essentially going to be over the $600,000 threshold. So that's
most likely, yeah.
Is there any precedence for this type of overreach, I guess, is for lack of a better word, where one government is requiring you to disclose information related to another state government or state, policy or titles information?
Well, it is quite unique, certainly from a land tax and state-based tax regime perspective. Absolutely unique in that sense. So what they'll do is essentially, how do they? The key question a lot of people are asking will be, well, how do they know what land I own in other states? Well, there'll be a positive obligation on investors to make a declaration, a statutory declaration every year as to what land they do own interstate, and provide those property details, provide the values of those properties. And this will need to happen by the 31st of October each year, or within 30 days of receiving a land tax assessment. So investors will, if they own Queensland property, they'll need to create a Queensland Revenue Office online account and provide these declarations. It is an offence not to declare interstate property. It's an offence to obviously give incorrect details, and the penalties can be up to $14,000 for doing so. So it is important that investors get this right. How do they work out? How do they know the values of their interstate properties? Most states will have online portals where they can actually search for those unapproved land values of their properties. But the easiest way to do it usually is just to check the unapproved land value, which will appear on your council rates notices, because of course council rates are usually based off the unapproved land value of the property.
So, it's legislation. It's not like this is for debate. It's there, and it's obviously it's very well thought through in terms of the disclosure obligations, and there's a legal process that there are legal consequences if you don't accurately disclose that. But is there any precedence, I guess, of contesting this? Can investors up in arms, and generally across the investor community, from my feedback is, what are they thinking? Why would they do this? And have we got any grounds here to argue and contest? It is obviously a government policy, so it is brought in by the current sitting government. How is there a scenario over the next year or so? It's obviously proposed for next year to be brought in. Is there a process where this can be protested or changed, or
Well, I mean, as everyone is entitled to a vote, so of course they can protest by way of showing their feelings known at the next state election, which is 2024, if that's a key concern for a lot of voters. But yeah, it is law now, and a subsequent government may of course change the law, but this essentially, it's law now, and it will then apply really in practice on 30 June next year, 30 June 2023. 30 June every year is when the valuer general values the land, and the Queensland Revenue Office calculates land tax liability. So essentially, any land you own on 30 June is then used to calculate the land tax liability. So if you've sold land property before 30 June, and it's obviously settled before then, then you won't get assessed on that land as at 30 June. So that's really the case there. Now, but another thing for investors to understand is that land tax is assessed on your ownership type of the property. So I mentioned before that an individual has a tax-free threshold of land up to $600,000, but if they were to own that land in a different entity, so as perhaps they establish a company to purchase that land,
yes,
or they've established a trust to purchase that land, or transferred that land to one of those other entities, which of course triggers stamp duty, then they would get the benefit of the tax-free threshold for each entity owning the land. So,
okay,
Jacob, for example, you might have an investment property in your own name, and that's under the $600,000 land value, but you might have another one in a company set up. You might have another one in a trust, and you would get the benefit of each tax-free threshold. Tax-free threshold for companies and trusts is $350,000. So you might not have to pay land tax in that case if each of the properties you own in those different entities, if the land values fall under those thresholds.
Okay, so it's probably a renewed. So just to clarify that, it is probably a broadly known concept that you can, if you're owning a property in a trust structure or a different entity, then you can have an individual threshold for each of those entities. So that is a strategy that has been employed by investors now for some time to minimise land tax obligations across their overall portfolio.
Yeah, with some exceptions, yeah.
Yes, and so this is probably bringing more emphasis onto that strategy, or even benefit to it. So if you have a property in New South Wales owned by a trust structure, and then a Queensland property, even in your own name, they are separate entities. So the Queensland government won't be going into trusts owned by the person to look at the overall portfolio value. It will be only, so even if it was you and then your wife owned another property in another state, they are separate thresholds.
Correct.
And then potentially a third property was owned in a trust structure, that is a third threshold as well. So that might be a way of minimizing.
That's right. And I think as a result of this new system, investors will need to really focus on their ownership structures when it comes to buying property. I mentioned exception before, and that's of course each trust is generally assessed separately for land tax, so you can set up as many trusts as you want, really. But of course, where there's a cloned trust, that doesn't apply. So they group together land tax liability for those purposes. A cloned trust is essentially where there's where there might be different trusts, but there's the same trustee and there are the same beneficiaries. The beneficiaries have the same interest in each of those trusts. So you can still have separate trusts with the same beneficiaries, but as long as they have different trustees, then you're okay. They won't group that together.
Okay.
So structuring your investments is critical in this environment.
So this would be for an investor, they're having a conversation with an accountant around structuring, about setting that up. Would they then engage you as a conveyancer for a purchase? Start having that conversation with you potentially a little bit earlier, and you might be able to help and guide them around, ticking off these structures, and if they are, correctly in place to minimize these land tax obligations. So that would be the order. They'll talk to the accountant, and they would be the ones that are working in alongside you as well to make sure that they are set up correctly.
Yeah, definitely speak to an accountant before you sign a contract to buy your next investment property.
Yes.
There's a lot to think about. Land tax is just one part of many things to think about in your structuring. So there are obviously tax considerations, land tax being one of those, and also asset protection reasons. So yeah, speak to your accountant first before you sign a contract. If you for some reason have signed a contract to purchase property and then realize you need to end up purchasing it in a different entity, then in many states there can be stamp duty consequences. Yes. There obviously can be ways to get around that. You can agree to rescind a contract with the seller and enter a new one with the correct entity. Or in some states you can nominate that entity without any stamp duty issues. It does vary by state to state.
Yes.
But of course, if you've secured a good deal with a seller, and then as we know, sellers sometimes realize after the fact that maybe you've got a bargain there, and you go back and ask them to change the buying entity and rescind the original contract, they may refuse or they may renegotiate the deal.
Absolutely.
So yeah, very important. It can be a costly mistake to get the purchasing entity wrong when you signed a contract. So definitely speak to your accountant and speak to your lawyer before you do that.
Well, probably the optimum process would be obviously talking to an accountant, getting structures set up, or having that conversation prior to then starting and embarking on looking at the individual properties. You're talking to real estate agents, you're asking them for a contract for the property, for the purchase. That contract then comes to you as the conveyancer. You are then looking through that contract, looking if there's anything iffy in there, looking at what the liabilities, etc., will be for you, and if it's, if you're comfortable with it, and that's when you as an investor would make it known to you as a conveyancer there, Richie, I'm wanting to minimise land tax obligations here. It is a priority for me, and then you'll just be confirming yes, the structures will allow you to do that. That would probably be the right process. Would that be correct?
We can definitely assist with that. Yeah, our standard service includes contract review, and as a standard, we always ask our clients, if you're purchasing this property as an investment, have you considered what entity you want to purchase it in? Have you spoken to your accountant about setting up the right structure for you to optimize the tax benefits or reduce liabilities? So with this, where we have an interstate client or even a Queensland client who owns property in the state, now with this new passing of law, this will certainly be a focus as well about asking the question: do you own interstate property? If you do, have you considered the land tax implications? You may need to establish a separate structure for this purchase to make sure you're not hit by unexpected land tax. I guess a big issue will also be, of course, for existing investors who have purchased, who own properties and haven't, obviously hadn't considered these new laws. So, how will they be impacted, and what can they do? Now, if they own it in their own name, then having to transfer it to a company or trust that they set up, that will incur stamp duty liability, which is significant, but maybe worthwhile depending on how long they intend to hold the property. They need to work out, well, how much will the annual land tax be in this structure, for the next 10 or 20 years, compared to paying a one-off a lot of stamp duty.
Absolutely.
If they do own properties in with the same trustee but across multiple trusts, so those a cloned trust arrangement, in most states they can actually change the trustee. Yes. So they might set up a new company to act as a corporate trustee of some of the trusts, and so they should, in that case, they may consider establishing those new trustees, doing a change of trustees, and that will be exempt from stamp duty in most cases. So that's another way to limit the impact of these changes.
Wonderful. So there are ways, that we can, I guess, outsmart the proposed changes and, keep almost going on as business as usual in Queensland. I mean, I think at a high level, I've just been sort of asking myself, why would they do this? It does seem like a money grab. Queensland as a state has extremely low vacancy rates. I was talking to Tom here in the team yesterday, and he said, as of yesterday, the 28th of July, there were 36% less properties available for rent than there were on the 28th of July, 2021. Okay, 36%. So over 1/3 of properties is removed from the rental pool available for renting. We've got, emergency low levels of properties available for rent across the country, and Queensland is no different. Queensland government is, traditionally behind the eight ball in creating public housing. You've got homelessness at sort of chronic levels, terrible levels in Queensland as well. So you'd think this would only, continue.
Exacerbate the problem. Yeah. That's right. I mean, it appears to me that these new laws, whilst they might make some local home buyers happier that there's perhaps less competition from interstate investors when they're buying a house, there are unintended consequences of that, of course. If investors feel like they need to sell their investment portfolio in Queensland because they're hit with a huge land tax bill, or decide not to buy properties in Queensland, then those properties that would otherwise be in the rental market, may not be going forward. So there's less rental stock, which can make the problem worse. And I'm in Brisbane, obviously, and we've had the floods earlier in the year, and that's impacted a significant amount of properties as well, and take them off the rental market. So it is a questionable policy, and I guess we'll have to wait and see on the long-term impact.
Well, I mean, and obviously I can't read minds, and you can only speculate with these things, but it does seem like it just is a money grab. It's not to disincentivize investors coming, because, in Queensland in particular, a lot of the markets that we're focusing in there, investors provide a critical service to locals, and a critical amount of housing. But to be perfectly frank, from our side, some of the markets that we've been tracking very closely in the last couple of weeks since this has been announced, I mean, there is just emergency low levels of properties available for rent. There's no new homes being constructed because the building industry is in an interesting state of affairs. So that rents are going through the roof, Richie. We're seeing 2% rental growth month on month in many locations across Queensland. So it's only getting worse. So without investors, less investors, even with these land tax costs, very quickly investors will be coming back into the Queensland market because of the juicy yields available. The rents are just going through the roof. So they'll very quickly be coming back into the fold. And looking at, land tax is a cost of doing business. That's okay. Well, with the rents increasing, that's offsetting things quite quickly, is what we're seeing. So
that's right, yeah, and another impact, of course, is that landlords may end up just passing on those costs by way of increased rent.
Absolutely.
To renters. So that will just add pressure.
So I think some really, really great takeaways, Richie, and thank you for coming on and sharing this. I think probably the gold nuggets here are we can, look at alternative structures to be purchasing our investment properties, really planning ahead for this. And it's probably put renewed emphasis. There are obviously costs associated with administering a trust each year, but it's put renewed focus back onto that as a structure. And then with land taxes going up, the costs associated with administering a trust might be the way to go. And then you're also looking at potentially reselling essentially a property that you currently own now into a trust structure, paying that stamp duty penalty on that transaction just to then minimize your land tax in the future. So that might be, paying $10,000 in stamp duty now to save $3,000 a year ongoing. That might also be something that investors can consider. But with what we're seeing in many markets across Queensland, with the chronic housing shortages that we're seeing and rents going through the roof, as you say, potentially that land tax cost will be very quickly passed over onto the rents that people are actually asking for these properties. Property investment is a business, in all ways. So we would probably see that as another form of inflation almost.
Yep.
Richie, how would so if someone is as an investor or even a home buyer looking at buying a property, how can they best contact Lawlab?
The easiest way is to jump on our website, www.lawlab.com.au. We've got an instant quote tool there, so they can get an instant quote without having to put in any of their personal details to get the quote.
Yes.
And if they like that quote, they can then actually order the service online, and we'll give them a call within 2 business hours of getting that order.
Beautiful. And probably what I love most about Lawlab is, and this is this is not an advertisement. This is something, truly, I think we've got a very deep relationship, and we love what you do over many years. Is their unique online transaction, or not, communication platform. It really does help and coordinate a transaction for success for all parties. We, have clients who definitely are very positive about how that platform supports the transaction and really does give them the information they need when they need it. So that's quite unique, and it really does support you as a business to operate across the country. It's a wonderful part of the service that you do provide.
Absolutely, yeah. We're very proud of what we've created in that platform, which is called Rundle. It brings all the parties to a transaction together. So, a buyer will be able to communicate and share documents and see the status of a transaction with us being there with them, with other trusted partners like their buyers agents or property investment advisors and their mortgage broker, and so it's very, very transparent. They get everything's up to date and very easy to use. If they can use Facebook, then they can use that, and they don't have to live in it. Of course, they still get email notifications like you do from any platform. So yeah, we find it's a way of keeping everyone up to date and making it as easy as possible in what is or what can be a very stressful time when you're buying or selling a property.
I love it. Very good, Richie. And even yourself personally, if people wanted to follow your commentary, or is there any socials that you're particularly active on?
Well, I don't know how active I am, but now and again, I do things on, you can check out my LinkedIn profile or Facebook profile, which is Richie Muir Lawyer. And but feel free to get in touch with me, even by email if you like, or give me a call. Our phone number here is 1-800-529-522. So happy to talk to anyone who's interested in, buying or selling property, or just wants to, a yarn about the legal part of that.
That's awesome. Thank you so much for coming on and shedding light to this new proposed, or it's not a proposed, the new land tax laws in Queensland. Richie, it's always a pleasure. Thank you.
Thanks, Jacob. Cheers. See you soon.